Good morning. Thank you, Sanit, for the invitation. I'm impressed with the theme, Sri Lanka economy, onwards and upwards, is quite appropriate in my view also. Let me just focus on the onwards and upwards of the central banking, central responsibilities, and the way forward. The SG is here. He will talk about the fiscal and other structural part of the reforms of the program. So, as you all know, I think we all are familiar with the situation that we had to go through last 2 years. I'm not going to talk a lot about the past. I think what I can say compared to where we were, especially in terms of central bank responsibilities, price stability, financial system stability, that the very challenging situation we had at some point, that we have been able to prevent for the collapse of both the in terms of country running into hyperinflation. There were expectations inflation will go up to 100%. We'll have a situation of hyperinflation, and also expectation of Sri Lanka rupee would go to 450, 500. There's a market perception at some point, and also the black market premiums. Parallel markets were going at about 20% premiums at some point, and also our reserves, usable reserves, came into as low as $25 million at some point, where we had to announce, government together, we had to announce the debt standstill, temporary suspension of debt standstill, and started uh, the process of restructuring government debt obligations, and as well as other necessary measures from both the governments and the central banks. So I'll focus on what the process that we did, and also the result and the way forward. So there are a lot of people now I see criticize the fact that interest rates were raised so high, and as a result, businesses, so SMEs, were basically going out of business. There are lots of employments and all these stories. That obviously, had to happen anyway to recover the economy, to curtail the excessive aggregate demand. You can't curtail the domestic aggregate demand without a painful adjustment process. That is why we had to raise interest rates. And as a result, excessive demand that was going through as a result of excessive monetary expansion, the central bank money printing, and suppressed exchange rates, and later exchange rate went without any control, going like floating without any safeguards. Those are the situation we had to prevent and curtail. If that continued, I think we would have ended up in a even worse anarchy situation. The country would not be able to talk about this kind of situation if we allowed that to continue. So first priority from our side is to address that part. That's where we had to raise interest rates. And with that, the uncertainties surrounding domestic debt restructuring also added more pressure on the government securities market. The uncertain premium obviously had a price for the government to pay. As a result, 3 months treasury bills went up to 34%. And SMEs had to borrow at 30%. Their pricing of credit and so high. Some basically found it difficult, and as a result, demand and also some of the import restrictions and some of the measures like banning open accounts and curtail the black market activities, all, and our guidance on the foreign exchange, that bankers know how we were able to manage the sharp fall in currency. And now after 1 year, 1.5 years, we see now situation is pretty much under control, and the inflation obviously came down to 1% at some point within 12 months. It has gone up to about 5 to 6%. That's on a transitional period. That's one of impact on the tax, value-added tax. We don't think there will be a second round impact. We will come back to inflation 5% going. That's our key responsibility as central bank, maintain price stability. Medium to long term inflation at 5% is something that we are very committed, and we have been given the mandate by the new act, so we will deliver that. That's the most important factor the predictability and stability of the monetary policy should be in terms of stable inflation, not in terms of stable interest rates. So that's why some of the misunderstanding of people. Stability does not mean interest rates fixed for a long period. Stability means inflation fixed for a long period, so that both the interest rates and the exchange rate through aggregate demand management will be much more stable if we can maintain stability in inflation. That is our mandate. So we are delivering that going forward in the new central banking act. We think we can, even without central bank act, if you can look at historically, other than 2021 and 2022, we have been able to maintain around 5% inflation for almost 12 years. But with the change in the monetary policy regime that came into that resulted in this kind of situation, now we are back into a formal inflation targeting regime where we can ensure and anchor inflation expectations, and that will also result in stable interest rates as well as stable currency. And also on the external side, I want to share the situation. We had very low reserves. Now we have been able to manage and build up our positions over $4.5 billion. Obviously, people argue that this is because of the suspension of external debt restructuring. Of course, that has helped to a certain extent. But when we start debt restructuring, completion of debt restructuring, start repaying external debt, there's again a speculation that this will have impact on the reserves. That we all know, the fact that external debt service payments, the reason why we are restructuring is to have a debt service burden for the government that is sustainable and that can easily meet the debt service obligations after restructuring, and also the fact that we are building up our resource to a comfortable level, which means it has never been a situation government debt service obligations are not funded through the market. So it will have no impact on the currency, even if we start repaying external debt for the government. That we will usually the practice in Sri Lanka. When our government treasury needs to service external debt, it's our responsibility to sell them dollars, and it's our obligation to build up sufficient buffers for us to be able to sell dollars. That's why we have been building up our positions, and even with the pressures on appreciation of the currency, we are using this opportunity to build up reserves at a faster than anyone expected. So if you look at the IMF targets, that they were basically expecting reserve build up much lower path. We have been able to overperform both the reserve target and also inflation target. IMF prediction was to bring down inflation to single digits by end 2024, but we were able to bring it down within first 3 quarters of 2023. 15 months before, IMF thought even reserve target is like that. So that's why we are confident that this is not necessarily IMF conditions. This is where we want to go. Even we want to do better than what we have committed on the IMF program. That is what is important on the IMF program. Partly the endorsement by independent party confirming to the all investors that we are in the right path. That's one important contribution from IMF program. That's why we are committed to that. Secondly, in the debt restructuring process, their confirmation that going forward next 10 to beyond, our debt is going to be sustainable, sovereign debt is sustainable, is another important the part that IMF would give us assurance. So that will give confidence for the all foreign investors and even domestic investors who would not go back to unsustainable debt going forward. I'm sure ST can talk about it, how he is going to manage with surpluses in the primary account and bring the debt burden down further on a sustainable level. That's where the IMF program commitment, and it's a next 4-year program. I think then next phase of the recovery, I think, let me just share about the growth. Obviously, when we have the strong kind of aggregate demand management policies, economy should contract. Without contraction, no aggregate demand can be managed. That's how 2022 economy contracted by almost 8%. Again, expectation was that even World Bank projection was 9.2%, IMF projection was 8.7%, but we were able to manage economic contracted just below 8% with all the policies, fiscal tightness, monetary tightness, and with that we are seeing the stability, demand management, both external demand and domestic demand both managed, and this is where after 6 consecutive quarters of negative growth contraction, we saw first time in Q3 2023 economy turn into a positive growth path, and Q4 I'm sure will be a much higher positive growth. So this is where next phase of recovery should be much more sustainable from 2024 onwards. We are confident. I think our prediction is that the central bank prediction has always been much more accurate than anyone else's prediction. If you look at even global independent agencies, everyone, so we have been able to project. And this year we think we should be able to get the economy fully recover back to close to 3%. We'll also be building up reserves to much higher level. I think if you look at the IMF expectation, gross official reserves should be about, I think, 6.5 billion. I think I'm sure we can outperform that. So with that, so I say if we have that kind of level of reserves, the service obligation can easily be met under the IMF program. The sustainable analysis, basically what we think as only published figures, annual external debt service payments should be below 4.5% of GDP compared to what we had almost 9% of GDP. It's a half of the external debt service burden, which we can easily manage without relying on the market purchases or without going to the market for forex requirement. That's why we are building up our reserves. So on the growth front, we are saying, and also on the inflation front, as I said, we are confident that we can maintain 5% inflation. That is the stability that we will be providing for the businesses, for the investors, that we have a stable inflation. And also I should mention a little bit about the banking sector, which is also our responsibility. There was a period, especially with the uncertainties on domestic debt restructuring or privatization, and the uncertainty prevailed at that point. There were very kind of concerns on the banking sector. That's why when we designed domestic debt optimization, we carefully taken out the burden on the banking sector, and just to ensure financial stability of the banking sector should be protected. I think the last thing any country wants is a banking crisis. That's where we have been able to. There are a lot of concerns in 2022 whether the banking sector would be able to go through this difficult period, because non-performing loans, stage loans, are going almost over 13%. Asset quality review also showed some of the concerns of the capital adequacy, the liquidity. There's a lot of concerns of the liquidity at some point in the banking sector. We provided immediate short-term liquidity facilities provided. So we're able to manage liquidity situation. Then liquidity situation is much better in the banking sector. And also in terms of capital, still we are very, banking sector's capital levels have been increasing. And non-stage 3 loans ratio from 13.5% now below 13%, 12.8%, is already peaked and coming down. So with that, with the completion of domestic DDO, now there much more certainty and stability in the banking sector. Obviously, there are certain things we need to complete that I just will touch on, which is the completion of the external commercial credit. The other part, we have bilateral credit, we have already completed in principal agreements. This is a formal process of getting into signing MOUs. The next part is to complete the negotiation and come into agreement with commercial creditors. Both the local banks who are holding a significant part, some part of ISBs, and also some of the loans to the government in terms of transferring CPC obligations to the government, foreign currency obligations. So those are in the process of negotiation. So we are confident, I think Sri and also both of us are very much involved in the process. We are confident that within a couple of months we should be able to clear all uncertainties and come to agreement, so benefiting both the commercial creditors as well as the for the government. Once that process is complete, I'm sure the uncertainty part of short-term things, and that will also pave the way, clear the next disbursement of the IMF program, the next tranche, due somewhere in June. So next month there will be a article for consultation and review mission coming here to look at the numbers and discuss way forward. So I think with that we are confident that we are moving in the right direction. And also compared to the countries, those who are going through this kind of a debt crisis with the BOP crisis, I think we have been able to come out of this crisis and stabilize and complete the negotiations much faster within a relatively short period, although it's almost 2 years. From the announcement of suspension, that was in April, we are hoping that we should be able to complete before the 2 years. Compared to other markets, I think it's, Zambia, Lebanon, Argentina takes a lot more time come to this kind of situation. I think that's the commitment and the ambitions that we are all having to complete this and get the country back into a recovery path. So that's where, and also I'm sure the ST will talk about the fiscal and also the state-owned enterprise and structural reforms. Another part is important one that I just want to add is that in this IMF program, the a strong pillar is to address corruption and governance, corruption vulnerabilities, and improve governance of the all public institutions across the public sector, including the judiciary, revenue collection agencies, the central bank, FIU, and other companies act, debt recovery, all these things. So that's a process. That also a new kind of a element of the government commitment to address all these things. This first time Sri Lanka has published and identified gaps in the corruption and the vulnerabilities that has been only published, and now government is going to announce the roadmap how to address all these gaps soon. So before the next IMF review, everyone going to see the roadmap how to address all these things. This is part and is important additional reform in addition to the state enterprise and other important reforms in other areas, structural reforms that will boost the country's ability to grow faster and improve the confidence of the investors in the process is much more transparent and the open processes that basically process will be improved going forward. That's on the governance part. So the banking sector, obviously, I think we are going to announce. Other part is that I must mention about the interest rates. The interest rates have now policy rates is between 9 to 10%, and short-term call rates is close to 9%. And the transmission, there was a delay in the transmission of the policy rates into market rates because the uncertainty that has now been cleared. Government securities rates are now back to normal territory compared to policy rates within single digit now. And with that, we are hoping market lending rates for the businesses should come down further. We are working very closely with the banks so that economy and SMEs and others can recover, can start their recovery process and growth and protect the employment and businesses. That's the way forward. And also we are going to issue another circular to strengthen what they call business revival units by the banks. We had one circular earlier. We're going to issue much stronger guidelines how the banks can help to recover businesses those are viable. And also there's a debate on the Parate law and debt recovery. That's where I think government probably has taken decision to suspend for some time, as we are seeing the media reports. I think probably ST can confirm that. But in our view, we need to have a strong debt recovery that will ensure access to credit for the businesses those are recovering. Without strong recovery process, banks will not expand their credit to especially SME and MSMEs. That is a quite negative move if that is going to be implemented. That I have to express my views on that. I have been very open on that. Basically, for MSMEs, and you can remember in 2017-18, there was at that time government announced the right of some small loans at that point by the especially non-bank financial institutions. As a result, the lowest level people lost access to credit. They stopped lending to that kind of small credit because government announced what they call the forgive some of the debts, and they stopped lending. That's why that push a lot of MSMEs into informal markets at very high rates. So the government, if the banks can't recover the leasing, the jewelry, the pawning, they will not get that business. That will basically negative for the economic growth, negative for the banks, not only for the banks but also the businesses. I mean, for the short term, we can think about if government wants some relief, but I think that's a move in the wrong direction. With that, let me, I think I covered the areas that central bank is responsible. I'm sure ST given me some time to share his views. Thank you very much.